So today I wanted to focus my video on taxes. Now there is a lot of confusion when it comes to taxes, and I really want to demystify the situation. So given that I'm a UK resident, I'm going to be talking about tax from that perspective. And of course, whilst I try to provide accurate information, it's always best to double check the facts that I am stating. So with that disclaimer out of the way, the first form of tax I want to talk about is what's known as the capital gains tax rate. So before I jump into what a capital gains tax rate means, I first want to define what a capital gain is. So in the realm of stocks and shares, we buy into companies, and let's just take an example of one of those companies, so Unilever. Now let's imagine for a second that we have one share and we initially bought the stock at £1. Now imagine that that one stock over time is then worth £12,001. So we've had a price increase of £12,000. Now you have a capital gains allowance, which means you can earn £12,000 and you do not have to pay any tax. So in our case of buying a share of Unilever at £1, holding on to the stock until it reaches £12,001 and then subsequently selling the share, then we would have made a capital gains of £12,000 and we pay no tax. Now if you were to sell this stock of Unilever at £14,001, then we would subtract the £12,000, leaving us with £2,000. And then for individuals that earn £50,000 or less, they would have to pay 10%. So 10% on the £2,000 is £200, and you would have to declare this price to HMRC and effectively hand over the difference. But there are ways to avoid this tax. So those who have seen my previous videos, you would have noticed that a few months ago I switched from the investment account into the ISA account. Now I still hold both of them, but if I was to make over the £12,000 within this invest account, then I'll be liable to pay the 10%. But because I have my money within a stocks and shares ISA account, I am protected from having to pay any additional taxes with respect to capital gains. Quick announcement. Are you interested in starting your own investment journey and want to receive a free stock worth up to £100? All you have to do is create an account and deposit £30 or more. Trading 212 is available for European residents also, so head over to the link in the description. Okay, so most are aware that I focus on dividend-based companies, and so every month or every 3 months, I receive payment from the companies I invest in the form of dividends. Now, different companies have different structures, but for the most part, there's several companies that are classified as normal dividends. So one company that is an example of normal dividends, at least in the UK, is Lloyds, and there's several others as well. So for the tax year 2020 to 2021, the normal dividends benefit from a £2,000 dividend allowance. So if you earn anything above £2,000 in the form of dividends, then basic rate taxpayers will pay 7.5%. But again, keep in mind, if you receive these dividends within a stocks and shares ISA account, like I do on the Trading 212 platform, then you don't have to pay the additional 7.5%. So now let's switch our attention to the US market, and we can see from my account that I invest heavily within the US market with US-based companies that provide me with dividends. So when you buy into US-based companies that provide you with dividends, there is something which is called a dividend withholding tax. Now, as a foreigner, and what I mean by foreigner is a UK resident buying stocks other than UK-based dividends. So in our example, we are talking about buying into US-based stocks, and UK residents are therefore foreigners buying into the US market. So when you buy into these US-based stocks as a UK resident, you will receive dividends, whether it's monthly or every 3 months, and 30% is kept from the US. And it's automatically applied, and that's simply because with the US, they withhold money, and they withhold a greater amount compared to the likes of the UK, where we have to declare how much we are earning. So 30% is kept from the US, and you are paid out the remaining 70% in the form of dividends. Now, you can reduce this to 15%, and that's just because a law was passed stating that if you are not a resident in the US, then you don't have to pay certain forms of taxation. And so that number is reduced to 15%. And this is achieved by filling out a form known as the W-8 BEN. So when you sign up to the likes of Trading 212, and I believe it's the same for free trade as well, you'll be required to fill out the W-8 BEN form for taxation purposes, and that just allows you to be taxed at the 15% and not the 30%. So whether you buy US-based stocks that pay out dividends within an ISA account or within your standard invest account, you will still be paying this 15% should you fill out the W-8 BEN form, or 30% if you fail to do so. Now, for those that do use the Trading 212 platform, you can always double check, send out a message to customer support. It's available clicking on the icon down here and clicking technical assistance, and you can double check to make sure the W-8 BEN form has been filled out. Even so, 15% is quite a large amount that UK residents don't receive in the form of dividends, and so you have to decide whether international markets are worth investing in. Now, not all international markets have a withholding tax, but you are limited by your brokerage firm or the platform that you use, because there's certain markets that you will not be able to trade in. So from my end, I still favor US-based markets. I'm aware that I'm hit by this 15% taxation on the dividends that I receive, but that's a decision that I'm happy with. I always have the ability to invest more in the UK should I wish to, and other markets as well, depending if the brokerage firm allows me to do so and they have the types of stocks that I am interested in. So that leads us nicely onto UK-based stocks. Now, regardless of the type of stock, whether it's a non-dividend or a dividend-paying stock, you have to pay what's known as stamp duty. Now, historically, the reason why it's named stamp duty is because a physical stamp had to be attached or impressed onto a physical document. And it's a system that originated back in Venice and then subsequently adopted by Spain, Netherlands, France, Denmark, Perugia, which is now a part of Poland and Russia, and then finally by England. So stamp duty is a payment of 0.5% on the given transaction. So those that use Trading 212, and I'm sure other brokerage platforms as well, you will see a breakdown on the stamp duty fee at 0.5%. So let's say you buy one share at £10, then you'll be paying 50p in tax. So keep in mind, if you buy one share at £10 followed by one more share at £10 and make two transactions, then you're going to be taxed 50p each time, and that's no different from issuing two shares at £20. It becomes £1 in the form of stamp duty. So 0.5% is not a massive deal. In the form of UK-based companies that provide you with dividends, it's definitely a lot cheaper to focus on UK-based companies that pay dividends, because you are just paying the 0.5% compared to the likes of US-based companies where you're paying the 15%. But for those who just focus on capital gains, then you have a decision to make, because international-based stocks such as the US, for UK residents, you don't have to pay any stamp duty. Concept doesn't exist. So that brings me on to the final form of taxation, and it's withholding tax in the form of REITs. So UK or US based REITs, the same withholding tax applies, which is at 20%, assuming you are a basic tax rate payer who earns up to £50,000 in a given tax year. Now, in the UK, we sometimes use the acronym PID, which just stands for Property Income Distribution, and that's what a REIT is. So the US introduced the concept in 2007, which means that property rental-based companies, which meant that companies could be set up where they distribute a large amount of their earnings and they pay it to their shareholders, and it's a way of not having to pay other forms of taxation which a company would incur should they not be defined as a REIT. Now, the UK adopts the exact same, so 20% is already deducted when a REIT such as Welltower or Main Street, Simon, etc. So when those dividends are paid out, 20% is automatically applied should you be investing in the invest account or outside of the stocks and shares ISA account. Now, should you have the stocks and shares ISA account, the 20% is not deducted, and that's just because the PID or the REIT is paid out in gross, which just means it's before any form of taxation. Now, what's great is that you will not owe any tax. So holding a REIT within a stocks and shares ISA account is completely tax-free, and when you withdraw any of the money, you don't pay tax. Holding within a stocks and shares ISA is great because you avoid the majority of taxation other than the dividend withholding tax. Now, every single year, the allowances change within the UK, and you find out what the new value is in April of every year. Now, this is probably obvious to most of you, but a stocks and shares ISA only allows you to invest £20,000 within a given tax year. And that is why people have to open up non-stocks and shares ISA accounts, because maybe they want to invest more than £20,000 within a given tax year. So I think it's really important that individuals have a basic understanding on when they need to pay tax and when they don't need to worry about paying tax. In my mind, having a stocks and shares ISA account really simplifies with respect to taxation. And for UK residents, there's a lot more of a manual process should we ever go above the allowances that we are allowed. So once you understand all the different forms of taxation, you can feel very comfortable knowing whether a given investment strategy works for you or not. So if you like this video, feel free to hit that like button and share the video with friends. And with that said, I'll catch you in the next one.